Hello and welcome to another instalment in LiveWire's 100 Top Rated Funds series. Today, something a little bit different. We've invited the researchers who do the due diligence on the fund managers that you've been hearing about to understand what they think is taking place in markets, how they go about assessing funds, and some of the opportunities that they're seeing right now. I'm joined by Aman Ramaraka from Morningstar. Aman, great to have you here in the Rocks.
Thank you. Thank you for the invitation.
Yeah, well, we're looking forward to picking your brain, all those years of experience assessing the fundies.
Yep.
But before we get into how you go about assessing fund managers, I'd love to hear about the topic that you and your team are spending the most time debating right now.
I think from a client perspective, anything to do with interest rates, inflation, income, I think are very much topical right now. It's an area where, given where interest rates are, a lot of people, particularly I guess on the defensive side of their portfolio, a lot of people are struggling to generate the income that they had previously, or perhaps they need in terms of if they're retirement portfolios. So that's a sort of thread of inquiry we're getting from clients, from advisors, and I dare say the fund managers are experiencing some very similar questions, particularly those who are in that sort of fixed income space.
And what are some of the ideas that are stemming from those discussions? It is plain and simple a massive challenge. How do you generate income when those traditional yielding assets are no longer doing that same job?
I think to some extent you almost have to have a think about what it is you want, particularly about the defensive part of your asset. So, people think about portfolio construction, they think about why I hold bonds, particularly sort of government bonds or investment grade. If you're holding that, there's a sort of general expectation that that is a defense against the remainder of your portfolio. So if that's your primary reason for constructing a portfolio using traditional bonds, as I guess is one way of thinking of them, then from that point of view, you have to almost accept what's coming down the pipe in terms of where rates are and what kind of returns. If you're thinking that part is an income generator, then that begs a slightly different question and has a slightly different answer attached to it. And invariably, it'll take you down, credit or high yield, or perhaps more sort of unconstrained part of the fixed income spectrum. But that also comes with some additional risk. There was a time where your traditional bonds gave you a decent return. Not being able to generate those types of returns is something that is now challenging.
Could you give me some examples of how that's impacting the way you're thinking about putting portfolios together?
Certainly. I think one, if you look at it from a top-down point of view, from an asset allocation point of view, over the last little while, holding cash was a good defence. Given where cash rates are now, we've decided, sort of some of our thinking around portfolio construction is to try and hold less cash and deploy more of that into the fixed income spectrum. So we're sort of seeing that. And then within the fixed income spectrum, also really thinking about what kind of managers you want. Perhaps if you are looking for income, looking for managers where that's a sort of a greater part of their process, a greater element of their product, in the sense that they are looking to generate more income. I think that's one of the things that we're doing from a portfolio construction point of view.
2020, the world got tipped upside down, and at the end of what had been a really long bull run, we had a deep drawdown and a correction. A lot of people we're speaking with, investors that use LiveWire, want to understand, was that a reset in the cycle? Are we still in the old bull market, given it was a health crisis? If you were to think about people moving through a cycle from sort of, the depths of despair through to skepticism into optimism, and then those euphoric peaks, using that as a simple framework, where would you say we are?
I think there's probably still a reasonable amount of optimism in the market today. I think certainly if you one sort of lens, not necessarily always correlated to the market, but one sort of lens of looking at it is just growth. If you look at all the forecasts for GDP growth, they all look rosy. They paint a fantastic picture, not only just this year but beyond. Sort of some reasonably strong growth numbers coming down. Now, some of that is a bit of a bounce off the depths of the pandemic and what happened to economies. But I think that as a forward-looking indicator is certainly something that's a positive. So people are sort of looking at that. Now, that doesn't always correlate to returns in the market, but the medium-term outlook for growth seems to be strong. And that would suggest that people are somewhat optimistic of at least the next couple of years, so to speak.
Well, let's pick up on that. Let's cast our mind forward, give ourselves a 5-year time frame. Could you share one or two themes that you think will be really important for driving returns for portfolios from here?
But one of the themes is ESG. Certainly sort of the shift to focusing on ESG as part of your investment is coming off a low base, but it is growing, and we're seeing more and more managers responding to what's that sort of bottom-up demand and thinking about what it means for their processes and the product sets that they have out in the marketplace. And the other piece of the puzzle, I guess, is very much on this, the sort of value v growth piece. We're seeing value come back hard, and I think that's an area where we're starting to sort of watch what that means for portfolio construction, so to speak.
Mm-hmm. On the ESG front, well, on both of those, those two areas, ESG and that value growth dynamic, are you able to share a few of the funds that Morningstar has reviewed or that have passed your filters?
We recently started to rate fund managers along what we call a ESG commitment level. And what we're finding is that compared to global counterparts, particularly European counterparts, the fund management industry in Australia is in early stages of sort of deep adaptation of ESG. Now, to be fair, in Europe, a lot of it's being driven by legislation. Here, it's much more about an iterative process of bottom-up demand.
It sounds like that's a very generous way of saying we're behind.
We are, yes, that would be. And certainly managers that we've rated so far, which is only a very small cohort of our overall coverage, some of the intentional strategies, people like Australian Ethical, we recently gave the highest ranking to one of our investment AIM, which is a fixed income manager in sort of the green bond space. They're two managers that have taken out our highest commitment level, which is sort of leader. But what it demonstrates is that if they've been doing it for a while, they have a very established process, they have a higher chance of getting better ranked in our commitment level. What we're seeing is a lot of managers starting to build out their ESG functionality, whether it's bringing people in, whether it's enhancing their processes. That's still occurring. So we anticipate that they'll catch up at some point.
What's an asset class that you think is underappreciated by investors and has an important role to play in portfolios?
I think something like infrastructure is probably, certainly institutionally and on the unlisted side, infrastructure's been in play for a long time. All the major super funds have been doing it. I think for retail investors, areas like property and infrastructure have suffered quite significantly. You think of airports and the like. But I do think that it's got some good long-term legs to it beyond, I guess, some of the dislocation caused by the pandemic. I think that's an area that we're watching very closely. There's some very good sort of global infrastructure managers that we rate that play in that space, and we think that that's an area that should continue to have an allocation in portfolios.
So all these years analysing and picking fund managers, if you were to go back to the start of your career and give yourself a piece of advice that would help improve your success rate when it comes to picking good fund managers, what would that be?
Having a reasonably healthy dose of skepticism is always a good starting point for a researcher. no fund manager is going to tell you that they're moderate or mediocre at what they do. They'll all tell you that they're good at what they do. So I always think that that's, if you start as a researcher along those lines, certainly that's a good starting point.
Yeah, great. Well, Aman, thank you so much for coming down today. It's a pleasure to have Morningstar involved in our 100 Top Rated Fund series, and I've really enjoyed hearing your insights on selecting fund managers.
All right, my absolute pleasure to be here. Thank you.